Welcome to the Royal Tax Podcast with your hosts, Megan Templeton, Royal Legal Solutions Consulting Attorney, and Royal Legal Solutions CPA, MBA, and CFO, Pete Schindele. Each week, they talk about how to take your tax and financial strategy to the next level and learn how to build and scale your real estate investing business in a way that maximizes your returns and minimizes your taxes. This is for informational use only. For direct questions, please contact us or your local tax CPA accountant.
All right, everyone. Thanks for showing up to today's Royal Tax. Megan Templeton will try to join later on in the episode. She has a conflict at the moment. So hopefully she's able to join because today's topic is going to be equity stripping. And hopefully someone today has done that so they can kind of share their thoughts and experience on it. Especially with the way the housing market's been here in the West, a lot of people have called and have asked questions on equity stripping. So kind of falls on last week's topic there towards the end on taking loans out on a residence to buy other residence. Who wants to kind of talk about what their group discussed from the breakout room? Any volunteers? Anyone excited to discuss this topic or no?
Yeah, I'm excited to talk about it. We actually didn't talk specific. We talked a little bit about interest rates.
Okay.
And we didn't talk about equity stripping, but I do have experience there, so happy to talk about it.
Great.
But yeah, I mean, look, a lot of us are concerned, with the increase in interest rates. Why did they increase it? Well, inflation and if you're really gonna put your finger on it, and the easiest way to say it is they're just trying to kill demand, to lower inflation. This might have an effect on, us purchasing. To me, I think if you found it just makes more emphasis on why you got to find a really good deal. If you find a good deal, then it's going to cash flow whether you leverage or not. So it's just more emphasis on finding something that's worth, investing in. Mm-hmm. As far as equity stripping going, it is a tool I use a lot. And a lot of deals, instead of going in as a partner, I'll very often go in as a friendly mortgage. And it protects the whole project because if anybody is sued, I've got a first, dibs on it. So I'll put a large mortgage on it and with verbiage in there where I get a split of the profits, not just a specific interest rate, and I defer the interest until the product is sold. This is usually with fix and flips, but just one example of what I do for equity stripping. And then there's other ones that I haven't used, but I've considered using, where you create a very anonymous company and put a lien against the house. It's more of a paper tiger kind of a way of doing it. I've considered it, but I haven't necessarily pulled the trigger on doing that yet.
So in essence, you've used it, and we'll get into more detail later on after we listen to the other breakout rooms, but you've used it in essence to draw cash to buy flips and then also be the first lien holder on it, to where if the flip goes upside down, you're protected or the asset's protected. And then the second time is you just created a fake lien to kind of show there was a lien on the property, so it wasn't as attractive and more as an asset protection.
I'll be honest. I've done a ton of the first. Okay. And I've heard of the second. I've considered doing the second, but I guess laziness or not wanting to create an entity that's going to have another $800 minimum California franchise tax.
Yeah.
Although I guess if I'm creating it out of state and I'm not using the entity, I'm just, in a sense, creating a fake lien. It's not really an active business. I guess it's not creating money. It's not really doing anything. So I don't know. It might be something.
Okay, great. Yeah, we'll look forward to hearing some of those a little later on, Chris.
Sure. And so to be more specific, I'm sorry, I just want a little clarification because very often when I do it on the first example, it's when I have most of my deals, I have partners and we have separate entities. And they're the ones who buy it, and I provide the capital for it and provide the lien. So,
okay, great. From the other group, what did you guys discuss, or was it more kind of off topic as well? which is fine.
Are we the other group? Is there just two groups?
Yeah, I think there's two. There might have been a third group looking at the breakout rooms.
Yeah, I was in a third group.
Okay.
Yeah, there's a third. In our group, we were just, we weren't really sure what equity stripping is. So we Googled it and we saw HELOC as a form of it. Nobody's done the lien type of thing that I saw described out there. And of course, I guess cash out refinance is another way to, reduce the equity position too by doing that. And and then there was a new person in our group and we just were talking about different investments.
Okay, nice. So the new person, are they getting into real estate investments, or have they been established, or did you not get that information?
Zahid, he's also here in California in Newark, and he could probably describe it for himself. Yeah, I see him building, but he's got he's got a commercial building and he's got some single family.
Oh, nice.
Zahid, you want to introduce yourself? Yeah, I guess he used to attend and he's just come back.
Oh, okay.
Hi, how's it going? Yeah, I'm not necessarily new. Yeah, I used to attend a long time ago and work's been crazy. So.
Oh, great. Well, glad you came back, and hopefully today's episode you'll gain some knowledge from myself and Chris and whoever else in the group is. So, all right, Chris, I saw your hand was raised. What question did you have? Or?
It wasn't so much a question, but just a comment on the whole HELOC thing. I recommend to really all my friends that have equity in their primary residence to get a HELOC. Well, let me rephrase that. All my friends that have discipline. And, because we all have some friends that if they find a pile of cash, they'll find a way to spend it. And I recommend it for a couple of reasons. One, in an emergency, you always have available cash right then and there. And as an equity stripping to protect you from liability, most lazy contingent lawyers will look on title and see that you have a HELOC on it and assume that the whole HELOC is taken out. So it's a good way on paper to look like it, that you are, have no assets. Most people, their biggest asset is their home, where they have the most equity. And if you can make it look like there is no equity, that could be very, very helpful.
Yeah.
And one last comment too is if you haven't done a HELOC before, they're actually very often banks will do it for you for free. Even the appraisal, they'll charge you and then if you go through it, they'll reimburse you for it. But I found them to be cheap, and in most cases, I either used it very short term for deals just for arbitrage purposes, but most of the time I've had HELOCs. They're just kind of sit there doing nothing except provide equity stripping.
Yeah, in my experience, and then also some clients, the HELOCs, usually most of the fees are waived, or if you have enough equity, you don't even have to get, you don't have to get an evaluation. The only thing I've noticed is if you sign up for a HELOC, sometimes if you don't meet the 5-year minimum, at least on the banks up here, they'll charge you like a $400 to $500 cancellation fee. Because if you switch from one company to another bank that might be offering better HELOC terms, if you don't meet what you sign up for, they may charge you $400 or $500, but that's almost as much as an appraisal, which you're getting back. As you said, most banks will give that back to you.
Even market it out to be the cheapest insurance that you can get out there.
Yeah. So, and as you said, what's really nice about the HELOC is if you find a deal you like right away, you can get that money, you can put the money down on the deal, and you can also later on do cash out refinance on that deal, pay your HELOC back, and then also take more equity out and then invest in other properties. So
agreed. But I will give the asterisk that better be a good deal.
Yes.
Safe. And it better be a distant person that does that, because the last thing you want is for a deal to fall through and it's affecting you professionally and personally.
Correct. And especially with the interest rates, maybe going up 50 basis points at a time, your cap rate on those deals, you need to make sure are pretty high, because that arbitrage can sink it or you have a loss then. So
agreed.
Yeah. Agreed. Anyone from the third or group that wants to speak, Brendan? Or I think you said you were in a third group.
Yeah, I was in a group with Andre.
Okay. Hey, Andre.
Fairly new to investing. He's in a couple of passive deals, but hasn't yet done one where he's in control. So he's kind of looking at interest rates, but not sure what to make of them going up. For me, we refinanced a couple properties this year, and pulled out a good amount of equity. So I feel like a genius having done it in January and February, but it's certainly impacting some of my plans, because I'm in escrow on 3 more properties, and plan to close on them for cash, but then I was going to refinance them to pull the cash back out for whatever comes next. Mm-hmm. And now I'm kind of anchored on a 4% 30-year rate, and so looking at a 5.75% rate or 6% rate.
I'm sorry, so you're anchored on?
Yes, mentally, I've got that as the floor. Why would I want to borrow at 6% if I was borrowing at 4% just a couple of months ago?
Yeah, so you said the key thing there, mentally, because we all tend to do that. But historically, even 6% is low by historic standards. But I get it.
And I've certainly paid more than that in the past. So it's kind of a short-term hang up that I need to overcome, but it has me not rushing to start the refinance process for these new properties yet, because at least part of me hopes that if this war in Europe calms down, we may see a bit of moderation in the MBS markets. And
I'm with you though. I have the same mental block, but I think I've gotten myself past it by just thinking, is there anything that you're investing in now where you aren't beating 6%?
Yeah, well,
right?
You're investing in stuff that you're not going to be able to afford a 6% cost of money on, then that's probably the wrong investment.
Well, I'm going to flip that on its head, because even if you aren't, if it's a 30-year mortgage and it's in a good location, and I'm assuming we're talking about rentals, as long as you're cash flowing, if you're not cash flowing like crazy and you've got a long-term time horizon, inflation and increased rents are going to eat at that payment, because that payment isn't going to change.
And a few years from now, you'll be thinking that you were a genius for getting 6% for 30 years if our rates are 8%.
Continue to go up. Yeah.
Well, and on the flip side, if you have it at 6% and rates go down, even with the big penalty, sometimes it's worth it. You could just refi out.
Yep. Because I guess that's one question.
The logical part, of the approach, those are all factors to consider. And
but I get it. Mental blocks. I get it.
The emotional thing allows me to just procrastinate and put off, working on the paperwork.
Have you considered buying down, points as well?
I always consider that. I never really do that because I can't see 30 years into the future. And
well, you don't need to. You just need to look. I know how much you love spreadsheets. I do too. You just put it in the spreadsheet how much you're paying for it and how long it will take you to pay it back. And in most cases, it's just a couple additional years. And if you're a long-term holder on a rental property, you don't need to look 30 years down the line. Just a couple more.
Yeah, I know. I do calculate what the break-even period would be and such, but then I don't anticipate that I'll necessarily be in those properties that long, and then I usually am.
Gotcha. So really, for you, it's just framing it at 6% is an okay rate still, historically for you.
Yeah, and look, ultimately, the business of the rental property is going to pay for that borrowed money anyway. So I'm really just looking at cash flow trade-off at the end of the day. And after a few years of inflation, it really isn't that noticeable.
Gotcha.
But I think you bring up a really good point, because I'm starting to look and wonder if getting loans is always the best option. I mean, leverage is really great, but if you're sitting on a whole bunch of dry powder and you can make a good return, I mean, look how much you're paying even on a 5% mortgage or a 4% mortgage. When it's 30-year, look how much is going toward interest, for the first few years. You're not eating at principal at all. And the older I get, the less leverage and the more cash flow I'm going to want. And it's just making me second guessing long-term leverage how much I want.
Yeah, well, I am sitting on a pile of cash from those refinances, and I'm looking at it with the inflation rates today and realizing I got to do something with it. And so
be careful. Sometimes, I've been in cash since a good portion in cash since the end of last year. And it would have gone back in the stock market, but I decided no. And I was going to put a whole bunch in bonds for my mom because she's in her 70s. And I'm like, I can't put it in bonds right now. And I can't put that really risk averse money in the stock market. And I'm glad I didn't. So, cash is, inflation is burning a hole in it, but, don't jump into it. And I'm not saying you are, but I'm actually more talking to myself in the mirror as I'm saying this. Don't jump into any bad deals or good or mediocre deals just because you're sitting on a bunch of cash.
Well, I've got 3 deals in play, so I'm confident with those. Now, you can always buy a few I bonds, and those are inflation indexed. So
every time I read about that, I get excited, and then I'm reminded, okay, this is going to sound conceited. It's only $10,000.
It's only $10,000. Yeah.
I mean, a year, or I guess $10,000 over I don't know, and then you can get an additional 10 if you're below a certain income or something like that. But I hate researching and doing plays that aren't really repeatable in larger amounts. It just comes down to what's worth your time. Mm-hmm. And look, that's a lot of money to a lot of people. So I don't want to sound like an ass, but I wish it was more than $10,000. I mean, what are those? There's like 9% right now.
$10,000 per person. You can buy it for your kid, and it's tax-free. Those interest for your kids are tax-free, and $10,000 per entity. You can buy it for your entity, and after 1 year, it's liquid. So I think it's a pretty good deal.
I did not look into it that much. Thank you so much, Julie. That's interesting. So can we create a DST that has a whole bunch of babies and each one can do $10,000?
You need a tax ID.
I think it needs an EIN. So
each EIN you can buy $10,000.
So if you lived in not California, you could set up a bunch of EIN LLCs in Wyoming and not have to pay the $800. So,
yeah.
But you get to see the ocean, so it's a trade-off.
Yeah. And I'm on my hill, so I can see above all the political. I'm not going to go in that direction.
Gotcha. Just good views.
There you go.
Anyone else have done equity stripping or anything like that, or plan on at least going to get HELOCs to, if we do have a downturn or recession where properties may be a little cheaper to buy, or is that no one's strategy because you don't see that happening?
Want more information? Join our community groups that exist to provide a space for like-minded people on a similar journey to learn, share, and network with real estate investing professionals and entrepreneurs. We meet weekly for an hour in Zoom to offer knowledge and accountability. Be sure to grab the link in our show notes.
I'm doing this. I'm in the middle of a straight up refi. And actually, I know Brendan. I don't know. It sounds like you're refinancing maybe individual single family homes, but the Freddie quotes I'm getting are like 4.5%. And so I decided to reach out to some of the regional banks in the Pacific Northwest, and I got one person to quote me 3.9. And
it only going to cost you 7 points.
No, there was. Well, I don't know.
Sorry.
But, I was pretty excited about that. So
that is exciting.
I think if you're not getting Freddie, Fannie money, you might get individual banks, regional banks to give better rates. Then than maybe lenders who are using agency money. I don't know.
Gosh, okay, am I naive here? I thought it was the opposite. I thought Fannie Freddie were the cheaper ones.
In general, they are, but if you do have some smaller banks that are sitting on a pile of cash, they want to get it put to work. So I haven't, I do have a couple larger multifamilies that I should, get off the pot and see about refinancing. But let me know how it goes, Jeff.
Yeah, I mean, maybe. We'll see.
Is that regional bank? Are they credit unions or just a normal where they're paying taxes and stuff?
I don't know. It's called Home Street. I just Googled top banks in the Pacific Northwest and started going through the list. So
yeah, Home Street Bank. Okay.
Now, did they tell you that they only do it in, is it like a credit union? Do they only do it locally? Jeff?
They actually have offices in Hawaii too, Charlie. So I was like, maybe I'll have to talk to them about doing that. Yeah, no, but I know Charlie is in Hawaii. But yeah,
Hawaii too.
They have actually Home Street. They actually have offices in the Southern Cal. They don't have any. I think they might have one in Sacramento. They don't have any here in the Bay Area. But I think they're in Oregon, Washington, so a little bit more than just up there in the Pacific Northwest. But yeah, I just started talking to him yesterday. We'll see where this goes. But I love seeing something below a 4, less than 4 is interest rate. So
yeah, they're here in Idaho as well. So I'm trying to pull it up to see if they're anywhere else. But
would you write in the chat the name of it, or what's the name of it again?
It's Home Street.
Home Street. Okay.
Home Street Bank.
Okay. Pete, quick question for you. I mean, does Royal Legal or look, I am a junkie for creative ideas. Have you seen any equity stripping creative ideas or that maybe some of us haven't heard of? Or
I know the main ones I've seen and aware of are mostly doing the HELOC cash out refinance or for asset protection. And I was hoping Megan would be on the call to speak on the legal side of this, but she had a conflict. People will put a lien up on their self. They'll do an LLC and then do the self lien. To, as you said, is when a lawyer tries to sue you, they'll Google what your house is worth and what the liens are. And people do that to kind of mask how much equity you have, to whether it's worth to sue you or not, or just to take, hey, their homeowner insurance policy is X, we're going to take X. So that's mainly what I've seen on my end from the tax side, but legal side, there may be other more creative solutions that they've done legally.
Well, I think from a legal standpoint, I mean, there's two ways to do. There's always probably more than two ways. It's my joke. There's two kinds of people in the world: those who think there's two kinds of people, and those who don't. But two things that come to mind for me. One is you can make it really easy in a paper tiger, which basically it's there for show. And then another that is legit and is a lender to go through. If it's just a paper tiger, I mean, an LLC, I think New Mexico is one of the easier ones because it charges the least or nothing and is anonymous, and you could just put it up there. Or you could even have a friend who has an entity and just ask them, hey, please put it up there.
Yep.
But if there's not monthly payments or there isn't a legit loan in place and money moved, any decent sized lawsuit's just going to see right through that.
Correct, because in a big lawsuit, they can ask whoever holds the lien, what's the value of the lien being held, and if they say, oh, it's $400,000, they've just committed perjury. So they're going to say, oh, there's no balance owed. So then they're going to know it is a paper tiger. But those are usually on the spousal ones. Spousal, when I've seen that, the spouse, people do it under their spouse name. So if you do it as a business and actual have payments and debt, then it's just like doing a bank loan. And if you're first on the mortgage, the second lien theoretically could force the property to be sold, but you would always recoup your money first. So, but likelihood of that happening is very low at that point. So, but again, as Chris mentioned earlier, and I'll restate it, if you're going to do equity stripping, make sure the deal's good, or make sure you're not going to buy a non-asset like a car or life insurance or putting it in the market or betting black on roulette. So just want to make sure you're disciplined. You don't want to.
I'm just going to mention only because we're in the same subject of using capital like a HELOC for deals and such. Probably the one piece of easy leverage, the easiest that I've used and has the most impact on me, especially early in my real estate career, was borrowing against my stock portfolio on margin. Now that can get kind of dangerous, but if you do it right and you do it in a limited way, it's a really easy way to get at cash if you've got, if you believe in the stock market and you've got money in the stock market. And for me, I've been in the stock market a lot longer than I've been in real estate, and I don't tend to sell stuff. So the capital gains on selling it and putting it into real estate is not a great option for me. So on deals, I'll very often borrow against my stock portfolio, pay it back, and wait till the end of the year when I might have some stock losses or something like that to balance against selling some stock. But it really gives you some opportunity. And I don't work for the company, but I'm just going to sound like I'm selling it. But if you do have stock, Interactive Brokers, I've had them for over 10 years, and they are by far the cheapest to borrow money against. And you're able to borrow, depending on your portfolio mix, up to like 90% of your portfolio. And although I would never do that, most of brokerage companies, they're like, you can borrow up to 50%. And before a margin call, I can go up to 50% and still have lots and lots of room there. So they're very, very cheap. I think I paid less than 1% interest. Actually, I don't know right now the interest rate rises, but like I said, I can go up to 90% against it. So there are a couple of things you need to do in regard to that. So hit me up if you can't figure it out, how to sign up for that. Again, no benefit to me except helping out my fellow investors.
And you said interactivebrokers.com. I'll put that up in the chat.
Yeah, I want to second Chris's recommendation of that. It's a really powerful tool, and know that there's a couple of different ways that you can borrow against stocks. One is the margin, but there's also other programs where like you pledge those stock assets for the loan, and that can be a lot cheaper than a margin loan.
Is that the same thing?
They are not the same thing, because a margin loan you can use to buy additional stock with. Like a pledged asset program, basically the stock is your collateral, but the proceeds from that loan cannot be put back into the stock market. And as a result, the prices are significantly cheaper. And, the way I've used them is, you need a big down payment, or you want to close the deal for cash. I get it out of there. And then over the next, number of months, I think about the longest I had a balance was about a year and a half. I try to look at it as a short-term thing, but it's a great tool if you have assets in the stock market.
Interesting. So I think it might be, I'm using margin like saying Kleenex for tissue paper. I mean, you're right. There's pledged assets, there's margins, there's Reg T, regular. There's a whole bunch of different terms that you can use. But just to be clear, what I'm talking about is I'm fairly certain it's still called portfolio margin is what they call it. I know some places like Morgan Stanley, they have it where they specifically call it pledged assets, but I am talking about literally where I can go in there, set up a wire, don't even have to talk to anybody online, and it gets sent out. So one quick caveat too, only because it's in the chat, somebody asked if they could do it and they mentioned 401k. Unfortunately, I wish you could do this, but you can't use margin in a 401k account, the retirement account. They don't allow it because they don't want you to take that kind of risk with retirement funds.
Yep. Thanks. I was typing that up, but you said it, so I don't have to type. So thanks, Chris.
No problem. I wish I could. It's where I've accumulated a lot of assets, or my 401k. I wish I could do some safe margin with it, but let me put it this way: you could do it. You're not allowed to, but I mean, you could set up an LLC, with your 401k as the owner, and probably end up doing it. But I wouldn't. You know what? Let me take this back. Is it I think you can do it in that way, but then it would incur UBIT because you're borrowing money. So you'd be taxed at a very unfavorable rate if you did go that route. But most companies I've seen said you can't do that. And then the ones that you do with some, roundabout ways, it's borrowing against your portfolio, which is another thing people tend to misinterpret, that there's no UBIT on borrowing money with a 401k, which there isn't if it's used specifically to buy or against rentals or against property. But any other kind of borrowing, you're going to pay UBIT, which you don't want to do.
Yeah, and also, you said you're W-2, Aziz, so that's going to be probably based on your company plan as well. So they may have limitations set forth in it as well that limit it to $50,000 for your primary residence at X% interest rate. So your employer probably has more constraints on your 401k, most likely.
Oh yeah, that's right. About borrowing against your your retirement account. You can not necessarily through margin, but just borrowing against it. You're right. And there are some things like a first home purchase or 50,000 or up to 50,000 or 50% of your 401k, whichever is smaller.
Yeah. And then usually the interest you pay on it refunds you're paying yourself interest, but at 4%, which maybe in today's market, that's awesome. But
well, wait a minute. No, I heard that was kind of, you could kind of have, there's some wiggle room there on what you can determine how much interest you want to pay yourself.
So through a company's
fair market rate or something, right?
Through a company one, they limit it to like 4 to 5%.
For a company one? What do you mean by that?
Like if you work for a Fortune 100 company and they're the 401k sponsor, they limit it to 4 to 5%. And that's what I assumed by him, I say a W-2, was that his company's plan, not his personal solo 401k type one, was more of a company.
Anybody else here play with a solo 401k? It's like the best investment vehicle I've ever used for so many reasons. If you haven't, you've really got to strongly think about it. Even if you've got a W-2, create a small entity on the side and do it, because it's just a fabulous way to invest for so many reasons. But I think we're getting off topic here.
It's all right. It's all about financing and how to buy homes.
Well, you know what? I'm going to take this opportunity to tell you guys something I really learned, and I'm going to be telling every investor I talk to. It's in regard to insurance. I've unfortunately had a fire at one of my rentals, and it's currently being investigated. It looks like it's arson. It's definitely arson, whether or not it was the tenant or not. But it looks like my plan, if the tenant intentionally causes the fire, I have no coverage on the property. If somebody other than the tenant causes the fire intentionally, it's limited to a $30,000 vandalism claim. So it's making me relook at every single policy that I have. Unfortunately, this was not a house worth a lot of money, but it's forcing me to look at all my policies now to see if I'm feeling adequately covered. And be careful, guys and gals.
My father had a fire in a vacancy, and it was apparently a homeless person had gone in there and intentionally started it, and the place went up really fast. It totaled 3 units, and thankfully everyone got out. But he, his insurance company tried to settle for $60,000, and it took him a year, but he finally settled for $380,000, which is what it's costing to rebuild 3 1-bedroom units. Fire is really pricey.
Yeah. I mean, I just always had assumed that fire means I'm covered regardless, and that's just not the case. So I'm looking at every single policy I have to see if I feel I'm adequately covered, and I encourage everybody else to do the same. You never know when something like that happens, and I'm not actually covered on that property, or I don't know yet. It's still in the investigation phase, but just hearing that it might not be covered made me think, you got to be kidding me.
So, Chris, on that coverage, is it more of a just replacing the structure, or is it also waive the liability if someone were to be injured? Or
oh God, that was it didn't say anything about the reducing liability. I can't imagine that it would reduce the liability coverage. This was purely, from what I understood, structural coverage. Yeah, and to be clear too, fortunately nobody was hurt.
Yeah.
With this, but apparently the investigation is showing that the same guy who did this one did another house down the block in the same evening. So we'll see where that goes.
That's unfortunate. So.
Yeah, it's messed up. It's messed up.
Then a quick time check. We got about 9 minutes left. I did want us to talk about, for May, we're going to have our next show on the 17th. So we will be off next week. If there's any topics or pressing issues you guys want to have us discuss on the 17th, just leave a note in the Discord channel and we'll review it and create that, the conversation around that as well. And I believe Ken is also listed in the chat previous shows we've done for the people that are newer to the tax show. They can go look at, especially the solo 401k, they can look at a previous show. There's a show on that. If you have questions, just post them in the Discord because a lot of this community is in it and they have experience with it. So, yeah, the solo 401k is huge if you're self-employed or have property and can create it for you. So,
I absolutely love it. And I took quite a few years ago, I paid 6-figure tax bill by converting it, over to Roth, just ripping off the Band-Aid. And it's not only tax deferred, it's tax free. A lot of and you just put a lot of your juicy deals in it. What are your feelings, Pete, on rentals with the 401k? I kind of tend to shy from that only because it's like putting tax free bonds in your retirement account. It's like there's so many benefits to having rental property. Why would you put it in a retirement account where you can't take those tax write-offs?
Yeah, so I think if you need to get rental property and that's the only way to do it,
that's your only discretionary money. Yeah,
I would go through the solo 401k and do it that way. One problem is if you keep that rental for a long term in 30, 40 years, let's say you hit 72 and you have your RMDs, you may have to liquidate that property to take out an RMD. So,
well, the age keeps going up.
Yes,
and I do. There are some interesting things that I've heard out there. I mean, for myself, I think if I go down that route, if I do have any long-term assets, or even if I just want to continue investing in my 401k, I don't want to be forced to do distributions. I'll just retire and have one of my daughters, who I'm sure will have an entity at the time, become an employee of them with less than a 2% interest in the company.
Yeah.
Since I'm still employed, I won't have to.
Well, if it's a Roth, you don't have to do RMDs, do you?
You do with a 401k, unfortunately.
Okay.
Roth. I don't know why they do that. It's so ridiculous.
Close down the entity and transfer it to to an IRA.
I guess. Yeah, I mean, look, that is an option. I just there's just so much more freedom with a 401k than with an IRA. I don't like dealing with custodians that always F up deals. They just do. They just F it up when timing is an issue. And then also there's the whole thing of like, you do one mistake, one prohibited transaction in an IRA, and it blows up the whole friggin' IRA. And 401ks are transactional. So, and UBIT and a whole bunch of other things, reasons that I favor the 401k. But you're right, it is definitely an option.
And honestly, in 5 years, things could be a lot different. And that option, there could be better options or worse options. So
there's no 100%. It's going to change.
Yeah.
It always does.
So,
and I'm fine with it. Just tell me the rules. I'll figure out a way to make money.
Correct. That's the nice thing about living here is they change rules, but they can always find loopholes. So
yeah, but I mean, I tend to maybe err on the side of being a positive person. And one thing that's very trending in this country ever since its creation is that they try to make things profitable for landowners. And they do that for a number of reasons. One, because that's typically your most valuable constituents if you're a politician, but also we're the ones providing housing for people. We're improving the neighborhoods. If you're not giving us good reasons to do so, we're going to have really shitty neighborhoods and no places for people to put a roof over their head.
Yep. Yeah. Taxes drive a lot of the social stuff that government wants you to do, and they incentivize you through taxes and tax breaks. So as long as they want people in homes, they'll keep incentivizing it. So regardless who's in charge. So, but, on a happier note, let's finish off that. I got a little cut off there, Chris. We got about 4 minutes left. Anyone have an uplifting story they want to share?
I just want to recognize Brendan's suggestion for the Blitz asset.
Yeah,
I think it's great. He's got the figure from Schwab there at 2.25%. Do you have a figure there, Brendan, for Morgan Stanley as far as what the Blitz asset interest is?
Yeah, I use Schwab, so that's the one that I have. There lots of brokerages have similar programs. They may have different names. Chris mentioned he uses IKBR and had a pretty good rate, although he doesn't know what the current one is.
It's 1.83 up to 100 grand. From 100 grand to $1 million, it's 1.33.
That's
$1 million to 50 million, it's 1.08.
It's great.
And that is fantastic.
That is, you can't beat that.
And if anybody can, please tell me, because I will move every penny over there.
I appreciate that, Chris. So those are some of the golden nuggets that come out from these type of sessions, right?
Yeah.
Because sometimes we know so much and we just, it's sort of out there until like last week, Julie mentioned something that engendered some additional conversation that I think Chris and I will get an alignment on. And then today specifically what Brendan had suggested on the Blitz asset. I'm in that situation today because there's an investment that I'm committed to do for long-term hold, right? And I believe in it no matter what happens. I'm committed to it and I plan to continue to accumulate. On the other hand, on the equity side of things, we got hammered, big time in terms of the value of the stock market, but it's getting to be paired up. The question is, do I sell that stock, although I believe in the company, versus leveraging it using the Blitz asset and then taking that and invest it in the one that I'm committed to for the future without having to sell that equity stock that I own today that I believe in that's been hammered in the market. I'll just use Robinhood as an example, right? And you know what happened when they opened up IPO and then they got hit big time. Right now they're just down in the gutter. But I believe that some of the stocks are going to recover, right? But that's not happening anytime soon. On the other hand, on the other side of things, which is basically what's happening in Web 3.0, which is this whole thing about blockchain, DeFi, and so on. So I'm committed to this one company, and some of you know about that. So anyway, thank you. I appreciate this because I pick up a thing or two here, which I think relevant at the end of the day.
Yeah.
I just like doing what the billionaires do. Elon Musk doesn't sell stock to buy stuff. He just pledges the stock and borrows against it, and he doesn't have to pay the capital gain for it.
Yeah.
It's
absolutely right. Because, I was that close twice, to trigger that, right? But it generates that capital gains, right? Yeah. And so you have a different set of issues to deal with. But right now they are pretty much kind of equal because, both of them have been hit, but the other one's getting hit to the point where they're equal. So what do? Do you just get rid of this, although you believe in it, you want to keep it, or do you leverage it and so you can accumulate this? Because I feel it's a buying opportunity.
I think one thing that that we may be overlooking here, and you've got to be careful if you're talking about stock like Robinhood, that is you've got a higher risk there. I mean, when I pledge assets, it's usually against Fortune 500, ETFs, really broad-based ETFs with, and a lot of them are different than each other. If your pledged assets are predominantly really risky stock, I would keep my margin exceptionally low because you're more at risk of a margin call. Actually, personally, I haven't invested very much in individual stock for quite some time. It's just one of the easy risks to get rid of. It's just going to sound exceptionally crude, but I mean, you're one CEO. Okay, I won't make it crude. You're one CEO doing something very bad away from losing 20% of your stock. Whereas if you're broad-based over quite a few different stock, you don't have that individual company risk.
Understood. But, at the time you've got a lot of retail investors going into the market. You got over 20 million users, and there was no one close to them, right? When you look at it. And of course, there was this whole controversial thing about the gaming and the rest of it. But everybody got hit as far as the IPO is concerned in the market.
Yeah, there are a lot of too big companies that failed. I mean, look at Exxon. Look at Enron. Look at who's the big brokerage firm that's slipping my mind right now that fell under
Lehman Brothers.
Yeah, or look at any of the original Dow companies. There's only one in existence today, and that's GE, and they haven't done well in decades. So just be careful.
Diversify. Yeah, we can't tell you what to do, but it's good to know some of the tools that are there. And I'd love to take credit for this tool, but Chris brought it up. I was just doubling down on his suggestion. But it's a tool I've used again and again.
Me too.
But I mean,
it's the very beginning. My first big deal I did by borrowing against my stock portfolio.
Yeah, it's a good information, right? I mean, you're looking at anything south of 2%. My God, right? We started off with saying, well, we're concerned about interest rates going to go up based on what everybody was saying, what's happening domestically and internationally. Potentially, or not potentially, it's going to go up more. So, and here you go, and you say, hey, if you got that stuff, you can get this for under 2%.
Well, those are variable rates. They're not going to lock you in that rate for 30 years.
It's variable, and we got to be very, very clear here. With something like Interactive Brokers, they're not going to call you and tell you you're getting a margin call. They're just going to sell your stock. Right. So be very careful with what you're doing if you're borrowing even close to where your margin could be called.
Right. Understood.
For those on the Discord, I did post a Forbes article on iBonds. I know for some people like Chris, they're not important, but just for a few odd interest. I'm just messing with you, Chris.
I deserve it. And thank you, Julie, for really opening my mind that, you could do it with all your kids and different entities. It's like a lot of work for $10,000, but it's probably worth it. Could be.
Just if anyone wants more info, it's there in the Discord channel.
You have to give up a bunch of your gain too if you cash it out within less than 5 years or something like that too.
No.
3 months worth of interest.
3 months? I think if you cash it within a year.
After a year, it's liquid. You can cash it out. You just give up 3 months interest, which is not much. But think about your kids. If inflation is high, they stay at this level, and how much money your kids can get when they go to college. And
keep in mind it's inflation indexed. So if it's giving you a high return, that means there's going to be a lot of inflation by the time they spend it. So $10,000 now.
It was a terrible investment up until recently. Terrible.
Yeah.
Horrible.
Yeah. But if you have better place to put that money, you can take it out after 1 year. So you're not locked there. And it's safer than bonds because when interest rate goes up, bonds value go down. iBond value does not go down. They guarantee your principal.
No, it does go down. If inflation goes down,
I'm talking about interest rate and bond value. If the interest rate for bonds go up, when you sell the bonds, you get lower price. However, with iBond, right, you get your principal back. Yeah.
Yep. Correct. Thanks everyone for showing up to the tax call today. It was informative. I learned something new. Hopefully you all did. Pretty much doing a margin call on your assets is a good way to get that 2%, but be careful. Do your research.
The downside to these calls is you go away with a to-do list. It's like, now I got to start looking at my insurance policies and take another look at the solo 401k. And
I just having a big tool belt. I may or may not use them, but it's always nice to know when a deal comes along and I've got to think creatively. I've got other avenues that I could, other levers I can pull that maybe we haven't thought about before.
Yeah, and if you're having insurance questions, we do have an insurance guy on staff now, Aaron. So
right.
He can help you if you have some questions or need to update your insurance policies. So that's another service we're starting to offer here at Royal Legal Solutions. So
thank you for listening to the show today. If you're feeling overwhelmed with taxes as they relate to your real estate business and investments, or you're unsure if you're doing your accounting correctly, fill out our 5-minute quiz. With the information from this quiz, you'll schedule a meeting with a Royal Legal Solutions advisor who will provide you with powerful tax-saving strategies on your first call. Go to www.royallegalsolutions.com/tax to fill it out.